The Rebel Capitalist Show.
As Lacey Hunt would say, how do we turn bank reserves into legal tender?
I think there's one of two ways. One of which I think we just saw happen, which was the Treasury spent a bunch of money and the Fed effectively monetized it. And I think if you go back to August of 2019, former Fed Vice Chair Stan Fisher wrote a white paper with the BlackRock Institute with two other former central bankers and said, listen, in the next downturn, here's what we're going to do. We're going to have to go direct. The government's going to run deficits and we're going to monetize it. And we saw that. And so I think that's way number one. And then I think the second way is when I hear central bank digital currency, the Fed wants to get central bank digital currency, and I keep hearing this over and over. What I hear in my head is this is how they're going to take the federal government's inability to do stuff out of the mix.
Exactly. Or the commercial banking system. Because in the past, the commercial banking system creates the dollars. Now we have this hybrid system, but the Fed is still at the mercy, so to speak, of the government and the commercial banks. How do they get around that? Well, they just have a central bank digital currency, and that's how they turn those bank reserves into legal tender.
I think that's exactly what's going to happen. Just out of necessity, because again, once you get to this 130%, particularly given the structure of our system, deflation is simply not an option. You can have slight periods of it, but it is not an option unless you are willing to allow the federal government to default on either its defense obligations, its entitlement obligations, or its treasury obligations. Because if you have sustained deflation, the U.S. government will nominally default on one or all three in some of those obligations in some form or fashion.
Okay, so the second pushback you're going to get is the yield curve. They're going to look at the 10-year and they're going to say, Luke, what are you talking about here? If what you're saying was true, we'd see the long end of the curve just completely skyrocket.
So that assumes the bond market's a market, which is sort of the first principle. Is if you assume the bond market's actually a real market, and people say, well, we're Japan. I say, okay, let's talk about that. Japan, the 10-year market, that goes days without trading sometimes. Second biggest bond market in the world. So you can't have it both ways, right? We're either Japan or we're not. Now, I said we're not Japan. I don't think we're Japan. The bond market has been telling us this, though. And this is what I've said is, if you take a look at where the U.S. has issued, there's been this really interesting trend where, and we've talked about this before, George, where we have gone from 3Q14, foreign central banks are still buying treasuries, then on net they stop. So then we have global private sector, German and Japanese big pensions, they're financing U.S. treasuries or financing U.S. deficits. Okay, still a very good creditor. Then 3Q18, FX hedge treasury yields go negative. They stop buying as many and start looking other places because of basically the FX hedging costs turned U.S. treasuries into the lowest yielding sovereign amongst the big sovereigns on a currency hedged basis. Okay, so who finances the U.S. government next? It's highly levered hedge funds. Well, that worked from 3Q18 through 3Q19 until the yield curve flattened and then went inverted. Well, then who finances it? It's the Fed. And what's interesting is throughout this whole time, we have seen, in 3Q14, if you go back to the Treasury Borrowing Advisory Committee reports from 3Q14, what you see is a plan for the U.S. government to extend weighted average maturity of treasuries up and to the right over time. In other words, they're going to term out the debt to give themselves more financial flexibility. And instead, that flatlined and that has gone down. They did the opposite. And they've been issuing more and more debt in shorter and shorter terms. Now, it's sort of like some say tomato, some say tomato. So to answer the question directly, when we had a supply-demand problem, where did we see yields blow up? We saw them blow up at the front end of the curve, which is exactly where you would. They're not issuing that much at the long end. They can contain the long end with the QE they're doing and the amount of duration matching. If the U.S. government actually issued its $3 trillion in deficits at the 10-year, you would see the 10-year at some enormous number. You'd see the Fed buying it all, and then the Fed would be trapped because now they owe that. The Fed had $3 trillion in 10-year debt every year for the next however many years. They could never sell that. That is absolute, outright, explicit monetization for the next 10 years. That has serious policy implications. If you issue it all at the short end, 3 months, 6 months, and they're doing 75, 80% at less than a year, you can always say, well, we're not monetizing. This is just short term. Remember what they said about not QE. This is not QE because it's all at the short end of the curve. What happened to short rates when we had a supply demand problem in 3Q19? They went to 8 to 10% in repo markets.
Yeah, what you're talking about is the repo spike. Just to be
We
clear,
saw
you're talking about the
48
repo
hours
spike.
of the real, we saw for 48 hours. And you saw how the Fed went from a 18-month program of we're going to shrink our balance sheet, 48 hours, we're growing the balance sheet again.
Yeah,
they
and by buying the long end of the curve. We're not buying those T-bills anymore.
Well, doing a little bit of both, right? But that's so the people saying that rates didn't rise, they did rise. It's just, it's like the phrase Phil Knight was quoted in, I think, 1997 or 1998. He said, everybody's looking for the next Michael Jordan on the basketball court, but he's walking up the fairway, right? Mm. So obviously referring to Tiger Woods. Right. And it's the same thing. Everyone's looking for this bond market blow up at the long end of the curve. It already happened at the short end of the curve. And the bond bulls will say, well, that was regulatory, and that was, and yes, it was regulatory. But again, you have to look back to why, and all of a sudden, beginning in 3Q14, did the US government start regulating banks and money market funds to buy all these treasuries? This is a classic playbook of an emerging. Argentina did this in 2000 when they lost their foreign financing. Who did they regulate into buying their domestic sovereign debt? The banks. Hey, we will give you a capital. You can use this as capital regulations, and we'll give you a discounted, a capital reading with your regulators. And so it's a little bit of what came first, the chicken or the egg. Say, well, they're buying so much in treasuries because they have to, because they're regulated. My view, and I think the preponderance of the evidence suggests they were regulated to buy these because foreigners stopped buying enough of them for a number of different, both economic and geopolitical reasons. And so that's what I would say is the bond market already blew up at the short end. And then everything else it's not really a market. I mean, we don't see a market. Have the Fed dump the balance sheet by Christmas. Let's have a market. Let's see. They'd probably trade like Evergrande bonds,
Yeah, that's a very good point. Let's take it to an extreme. That always is a good thought experiment to try to understand what's actually happening.
Yeah, it informs the means, right?
Yeah.